Well, turning over to Washington, two big issues in the spotlight. U.S.-China trade talks are going well, but could continue tomorrow, according to Commerce Secretary Lutnick. Meanwhile, the budget bill continues to make its way through the Senate as the July 4th deadline looms. Joining us now to discuss is Jason Furman. He's former chair of the White House's Council of Economic Advisors and currently a professor at Harvard's Kennedy School. Jason, good to see you. So let's talk about inflation in the context of what's happening with this bill and, the fact that spending isn't really something that's being tackled here. What's your sense of how well the economy is holding up at this point, the disconnect between soft and hard data, and how this bill factors in?
Yeah, so I think largely the real economy is holding up surprisingly well. We are seeing some slowing in labor markets, but I think that's more about potential growth is slower because we have less inflow of immigrants. So it's more about the supply side than it is any sort of demand deficiency the Fed could do something about. And frankly, I believe the hard data, at this point more than I believe the soft data.
Okay. And these China trade talks, I know you think that the administration should have really taken on China with trade before throwing it to the rest of the world as well. But what would a win look like out of this stage of the negotiation?
Look, the problem is that the only people in the room right now are the United States and China. China has a lot of cards here because we need those rare earths for our industries. We don't have a lot of cards. And so, yeah, the talks are going well, but it looks like they're going well because we're going to give up potentially some of the Biden-era restrictions on exporting chips to China, restrictions that made a lot of sense for our national security, and in exchange for what? Just to get back to the place we were a few months ago. So we might, as a result of this negotiation, end up in a worse place vis-a-vis China than where we started the Trump administration.
Jason, I know we're getting CPI tomorrow, key inflation reading, given everything we've seen with the implementation and also shifting of all of these tariffs here and what that's going to mean for the good side of the equation, in particular in the inflation data. But how closely are you watching the labor market as well? Here's why I ask. Because Oxford Economics put out a report this week, and they said for the first time since 1980, unemployment among recent and new college grads is higher than the national average, close to 6% versus a national average of 4.2%. I wonder what you attribute that to and whether we should be paying closer attention to something like AI adoption in the midst of everything else we're talking about regarding this economy.
Yeah, so the labor market is a tricky thing to watch right now because what the Fed can do something about is demand problems in the labor market. If businesses are worried, so they're not hiring, you cut interest rates, they hire more. But if businesses aren't hiring because of productivity shifts, that's not something you can really solve with the Fed. If there aren't workers because of limits on immigration, that's not something you can really follow with the Fed. So the labor market right now, you need to look at the headline numbers, but then you need to unpack what the different causes are. Is it demand? Is it supply? Is it reallocation? And all three of those could be operating in a big way right now. I think it's more supply, and then as that Oxford report pointed out, reallocation that's at work there.
Now, I know we have the Fed in a blackout period right now. We get a decision, next week? They've been very clear on the fact that they're following the data, and right now they feel like they can be patient and don't have to do anything. But say the time came for the Fed to begin cutting rates again. How much would it actually affect what we're seeing in the long end of the yield curve right now and what we're seeing more broadly in the bond market?
I don't think it would affect it that much. I mean, a lot of what we're seeing in the long end is, issues with the term premium, concerns about risk associated with the United States, where we're going to be with inflation in the future, and the like. I don't think it's incredibly dependent on that path of short rates right now. But the Fed is right to be patient. The data, neither the price data nor the jobs data are screaming out. And I don't think they should cut rates unless we see a real market deterioration in the job market, not just little hints of slowing.